A market you've probably never looked at once in your entire life may have already cost you tens of thousands of dollars, maybe even hundreds of thousands. Not the stock market, not crypto, not inflation. The bond market. A $145 trillion machine operating quietly behind the scenes, influencing the interest rate on your mortgage, the return on your savings account, the value of your retirement portfolio, and even the stability of the company that pays your salary. What's remarkable is that most people have no idea how it works. Many have never owned a bond. Many have never checked a treasury yield. Yet this market influences some of the biggest financial decisions they will ever make. Every time a family buys a home, every time a company borrows money to expand, every time a government finances its spending, the bond market is involved. It sits beneath the entire financial system like an invisible foundation. You rarely hear about it on social media. It doesn't generate the excitement of soaring tech stocks or the hype of a new cryptocurrency. But unlike those markets, the bond market helps determine the actual cost of money. And when the cost of money changes, everything changes with it. Mortgage payments rise, business investment slows, consumer spending weakens, asset prices adjust. Entire economies begin to move in a different direction. The people who understand this market are not necessarily smarter than everyone else. They simply understand the machinery operating behind the curtain. Because the most powerful forces in finance are often the ones that attract the least attention. And once you understand how the bond market works, you'll start seeing connections that most people never notice. You'll understand why borrowing suddenly becomes more expensive, why retirement portfolios can lose value even when they're supposed to be safe, why recessions often seem to arrive out of nowhere, and why a market that most people ignore may have more influence over your financial future than any stock you've ever owned. Today, we're going to pull back the curtain and explore the invisible market that quietly controls the flow of money throughout the entire economy. Most people think bonds are something only banks, investment funds, or wealthy investors care about. But the reality is very different. Every time you take out a mortgage, every time the company you work for borrows money to grow, every time a bank changes its interest rates, the bond market is involved. It's the invisible system sitting beneath the entire economy. You can't see it. Most people never think about it. Yet nearly every major financial signal passes through it. The problem is that most people spend their time watching stocks. They follow the latest market headlines. They track tech companies and stock prices. But the market that actually helps determine the price of money is the bond market. It influences how much it costs to borrow, how much you earn on your savings, how businesses invest, and how the economy moves forward. The bond market may not be as exciting as stocks. It rarely makes headlines, but its impact is everywhere. And if you don't understand how it works, you're ignoring one of the most powerful forces affecting your financial life. Fortunately, you only need to understand one simple rule to understand the bond market. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. That's it. It sounds simple, but this single relationship is responsible for some of the biggest movements in the financial world. To see why, imagine you own a bond that pays 3% interest every year. At the time you bought it, that seemed like a reasonable deal, but then something changes. The next day, the government starts issuing new bonds that pay 5%. Suddenly, investors have a better option. Why would anyone buy your bond when they can earn a higher return somewhere else? They probably wouldn't. At least, not at the same price. If you want to sell your bond, you'll need to make it more attractive. And the easiest way to do that is by lowering the price. The lower the price goes, the more appealing the bond becomes to potential buyers. That's why bond prices fall when interest rates rise. And the opposite is also true. When interest rates fall, older bonds paying higher rates become more valuable. As demand increases, their prices rise. This simple rule may seem small, but its impact is enormous. It affects investors, retirement funds, banks, governments, and financial markets around the world. In fact, The massive bond market losses seen in 2022 can largely be traced back to this one relationship. Interest rates moved higher, bond prices moved lower, and trillions of dollars in value disappeared as a result. All because of one simple rule that every investor should understand. This is where things start to get a little scary. Most people assume banks simply decide what mortgage rates should be. But that's not how it works. Before setting mortgage rates, banks pay close attention to the yield on the U.S. 10-year Treasury bond. Then they add a risk premium on top. That number becomes the foundation for millions of home loans. To see the impact, imagine a home buyer named Brian. Brian wants to borrow $400,000 to buy a house. When mortgage rates are low, his monthly payment is around $1,600. The loan is manageable, the house fits his budget, everything looks fine. But then bond yields begin to rise. Mortgage rates follow, and suddenly Brian's monthly payment jumps to nearly $2,900. Nothing else has changed. It's the same house, the same buyer, the same loan amount. The only difference is the bond market. Yet that one change completely transforms the cost of homeownership. Over the life of the loan, Brian ends up paying more than $450,000 extra, almost $500,000, not because he borrowed more money, not because he bought a bigger house, but because bond yields moved higher. The bond market never called Brian. It never sent him a warning. It never asked for permission. Yet it quietly handed him a bill worth hundreds of thousands of dollars. And that's the hidden power of the bond market. Most people never pay attention to it until it starts affecting their lives in ways they never expected. For decades, investors were taught a simple rule: stocks are for growth, bonds are for safety. It became one of the most widely accepted ideas in investing. When markets became volatile, investors were told that bonds would help protect their portfolios. When retirement approached, many shifted more of their money into bonds, believing they were choosing stability over risk. And for a long time, that assumption seemed reasonable. Then came 2022, and that belief was put to the test. The U.S. bond market suffered its worst year in modern history. Bond funds that millions of retirees trusted for safety experienced significant losses. Investors who thought they were holding the conservative part of their portfolio suddenly found themselves losing money. Even the classic 60/40 portfolio, 60% stocks and 40% bonds, struggled badly. For decades, it had been considered one of the safest and most reliable investment strategies. Yet in 2022, that portfolio lost roughly 16% of its value. The shock wasn't just the size of the loss, it was where the loss came from. The asset that was supposed to provide protection was falling alongside stocks. The seatbelt people trusted was falling with the car. And that's the lesson investors learned the hard way. Not every bond is safe. And not every investor fully understands the risks they're taking, because safety in investing is rarely about the label attached to an asset. It's about understanding how that asset behaves when the world suddenly changes. There is one number that most investors never look at. It's called duration, and it may be one of the most important risk measurements in the entire bond market. Duration tells you how sensitive a bond fund is to changes in interest rates. In simple terms, it estimates how much a bond fund's value could rise or fall when rates move. For example, imagine a bond fund has a duration of 6. If interest rates rise by 1%, the fund could lose roughly 6% of its value. Now imagine another fund with a duration of 17. The same 1% increase in interest rates could cause that fund to lose around 17%. That's a huge difference. Yet many investors never notice it. They simply see the word bond and assume the investment is safe. But duration can dramatically change the level of risk. Imagine two investors, each putting $500,000 into bond funds. Both believe they are making conservative investments. Both own bonds. But one fund has a much higher duration than the other. When interest rates rise, one investor may lose tens of thousands of dollars more than the other. Not because they invested a different amount, not because they chose different asset classes, but but because they were exposed to different levels of interest rate risk. That's why understanding duration is so important. Knowing that you own bonds is not enough. What really matters is understanding how those bonds are likely to behave when interest rates change. Because in the bond market, the risks you don't see are often the ones that cost the most money. One final reason the bond market is so important is its ability to signal what may happen next. It does this through something called the yield curve. Under normal conditions, long-term bonds offer higher yields than short-term bonds. That makes sense. Investors usually demand a higher return for locking up their money for a longer period of time. So the yield curve normally slopes upward. But sometimes something unusual happens. The relationship reverses. Short-term bond yields rise above long-term bond yields. This is known as a yield curve inversion. And when it happens, investors pay very close attention because the bond market is sending a warning. It suggests that economic growth may weaken in the future. It suggests that investors expect lower interest rates and slower conditions ahead. Over the past several decades, many of the major U.S. recessions were preceded by an inverted yield curve. Not every signal is perfect, but its track record has earned the attention of economists, investors, and policymakers around the world. In other words, the bond market often sees trouble before everyone else does. While most people are focused on today's headlines, the bond market is already looking months or even years ahead, and that's what makes it so powerful. It doesn't just influence the economy. Sometimes it helps predict where the economy is going next. The bond market often sees the storm forming long before the rest of the world realizes it's on the horizon. The bond market is not just a game played by Wall Street professionals. It's the invisible machine helping determine the price of almost everything in your financial life. The home you buy, the money you save, the investments you own, even the economy that provides your income and opportunities. Most people never think about the bond market. They rarely follow bond yields. They rarely pay attention to interest rates until those rates start affecting their lives. But behind the scenes, the bond market is constantly influencing the flow of money throughout the entire economy. It helps determine borrowing costs. It affects investment decisions. It shapes consumer spending. And it sends signals about where the economy may be heading next. That's why understanding the bond market matters. Not because you need to become a bond trader, but because it influences so many of the financial decisions that shape your future. And once you understand how it works, you'll start seeing connections that most people never notice. You'll understand why money becomes more expensive, why markets react the way they do, and why some of the biggest financial changes often begin in places most people never think to look. Because when you understand the bond market, you no longer see money the same way. You begin to see the invisible system quietly